Okay, we're back with Jon Daurio. He is a Southern California-based finance entrepreneur, a pioneer in the world of mortgages, especially distressed debt, known as NPLs. Jon, you're a graduate of Harvard University with a major in economics. You completed your MBA and your JD at the University of Southern California. Your big score to date was a 4-year stint as the founder, CEO, and chairman of Kondaur Capital Corporation, which started as a privately held mortgage investment fund, and then since morphed into a still privately held, but a special servicer more. Your Kondaur, this company that you founded in 2007, really has remained an 800-pound gorilla in the distressed mortgage space. And it's one of the few places where accredited investors can purchase single non-performing loans from a reputable financial counterparty. Thank you for being here again, Jon.
My pleasure.
In our last conversation, we started to talk a little bit about the inefficiencies in the mortgage market and whether it's on the origination or on the mortgage servicing side. You mentioned that there is a shadow population of these Americans with poor credit scores, therefore limiting their access to mortgage financing. But in actuality, many of these borrowers seem to be great customers. They're making payments, they're just carrying high debt loads. So they're not able to refinance their mortgage through the traditional routes. Now you're looking to tap into that market as an originator in what is known as the non-QM space, the non-qualified mortgage space. Tell us a little bit more about that, about what you were just speaking of.
Sure. There are, I believe, well over 1 million homeowners that are being shut out from obtaining mortgage credit because of their credit score. And think about it, a credit score is nothing more than automated underwriting. I remember when I got into the business in the 80s, underwriting was done by hand. We didn't really have much electronic assistance, although we all hoped to be able to develop automated underwriting. We thought that that kind of efficiency would help. And that efficiency has led to a phenomenal market for qualified mortgages or entity or loans that are sold to one of the GSEs, the government-sponsored enterprises like Fannie Mae and Freddie Mac, and really help to get us out of the doldrums of the financial crisis. Was the FHA? I don't remember what it was, a smaller percentage of the market in the financial crisis, and coming out of the financial crisis, it became almost the only outsource for the loans. FHA, I believe, was well over 70-80% of the loans that were being made post-crisis. So automated underwriting, unfortunately, leaves out a lot of good borrowers. There are borrowers, like you say, where they're making payments, but their credit score is low because they're carrying a lot of consumer debt. And of that consumer debt that they're carrying, that it has a high degree of utilization, meaning the amount of credit they've actually taken out versus the amount of credit available to them. $9,000 outstanding on a $10,000 credit card, something like that. But they also sometimes just have life happen to them. A divorce, an illness, a job loss, something that causes either expenses to increase or income to decrease, or both. And during that time frame, when they have this life crisis, they deplete their assets. And when their assets are gone, they start running up credit cards or consumer debt. And then if it still isn't resolved by then, they start defaulting. All three of those things lead to a lower credit score. And what happens is the life event passes. The illness is cured, or God forbid that particular spouse or somebody dies, or the divorce is finalized, or they find a job, and so now they have income again. But because they're tagged with that low credit score as a result of that singular event that took place in their life, they're unable to get especially an owner-occupied property. And the reason why I say especially an owner-occupied property, because on an owner-occupied property, the lender has to comply with the ability to repay rule.
Right.
People are very, very, very nervous about how the CFPB will interpret the ability to repay rule, because it has not really issued any regulations to help us to calculate the income side nor the debt side. You know, one of the things that the mortgage market has done traditionally is when they're calculating the amount of debt, all they really do is look at the debt that shows up on the credit cards. But there's a ton more debt that doesn't that shows up, I'm sorry, on the credit report. There's a ton more debt that doesn't show up on a credit report. You know, I was going to take my cell phone out, but that's what I'm talking on. Cell phone. Your cell phone bill, again, unless it goes into default, many times does not show up on a credit report, and that's a significant contractual obligation. Gym memberships, things like that. And so what we really want to do with originating a new type of non-qualified mortgage is to approach it almost like a commercial lender, in the sense that we look at the household as a business and look at exactly what dollars are coming in and what dollars are going out. And of those dollars going out, what are they going out for? Is it an item that's a luxury item that in theory can be eliminated if there's some sort of issue with expenses or income? Or is it something that they can't really easily get rid of? For example, a car loan, if you have a car loan and it's a single car, and let's say you bought modestly or something, you can't get rid of your car. You need transportation potentially. So that's a bill that you can't get rid of.
Right.
So I believe that even though my loans might have an 8 or a 9% interest rate, because I'm paying off credit cards that might have a 28% interest rate, you know, high 20s, and also typical credit cards, their minimum payment is based on an amortization of only 18 years, where a mortgage loan is amortized over 30, and therefore will have a lower monthly payment. Also, so many borrowers have tapped into these unsecured loans, one main, cash call, etc., where I've seen that they're carrying in the triple digits of percentage rates. And therefore, being able to make a debt consolidation refinance loan where the cash outflow drops, I anticipate that there are great borrowers out there that are keeping their head above water with a debt to income ratio north of 80%. And I'm going to drop them to below 50%. That's really what's going to give them, I believe, the breathing room to improve their situation, which will in turn improve their credit score.
I love this. You know, I've actually seen this. I thought of something like this a few years ago when CFPB came around. It kind of stalled the ability to give this type of mortgage to owner occupied. So you've seen a lot of funds out there doing real estate based asset loans to investors. You know, HMC is out, you know, slinging millions of dollars nationwide to investors at low LTVs. But that's a lot different than your average everyday homeowner. And just if you don't even talk about life events that have happened in the last 5 years, if you just go back to 10 years ago, a lot of the people who had problems back then, you know, they're still trying to repair their.
Right.
So you know, these people are in a no-win situation. Here you are providing an opportunity for a win-win where you can have investors in your origination business that are getting a higher yield than they would just doing regular QM loans, and you're able to consolidate out credit card high interest loans from people. You know, it just seems very positive. And I'm going to ask you the tough question, right? Which is, what do you say to those people who are cynically turning to this, what you're saying, and say, well, you know, people want to use their homes as an ATM to consolidate debt, or, you know, isn't this what got us into this in the first place? And why should we this type of loan, basically like a bailout for the consumer? Why should they be able to tap back into the equity? I think there's a misunderstanding about what happened 10, 15 years ago. And what do you say to people that maybe are a little more cynical about this type of loan?
I say, God bless America. And the reason is because why should we be so paternalistic that somebody can't take advantage of their typically their most valuable asset? Because again, I anticipate that my weighted average loan to value will be 70%. So these homeowners have done something right to be able to develop equity in their home. It's not like the crisis that we had in '08, where people bought their home at 100% stated income loan, where the only reason why they had some equity was because of the radical home price appreciation that we had in the call it later early 2000s to the mid 2000s. It's typically because they've done something right, and as you pointed out, a lot of these borrowers have still been unable to get out of the hole that was dug during the financial crisis, because during the financial crisis, there were a lot of people that didn't get that 100% stated income loan, that had a more normalized loan. They put 20% down. They got a fixed rate instead of an adjustable rate or whatever. But because their equity was wiped out basically within a 2 or 3 year period and a life event occurred, they lost their job. How many businesses were wiped out? Look at even just our business, right? How many mortgage people lost their jobs? How many realtors lost their job? How many appraisers? How many contractors? All these people that lost their jobs. And as a result, they now carry a lower credit score, which I believe unfairly penalizes them when you try to go back to a manual underwriting process where you look at and say, okay, is this somebody that's likely to repay my loan? And look at that in a situation where just because they might have had a history years ago of not paying loans, maybe they're paying it today. And that's what we want to look at. But I will tell you, there are loans that I'll make to somebody that's currently down on their mortgage. And that's because I believe that when some people get into a situation where they have to make a choice, do I pay my mortgage or do I make my car payment? They realize, especially today, they don't make that car payment, it might get repossessed. But with everything that has happened in the mortgage industry and trying to delay the foreclosure of a home, a lot of people are choosing not to make that home payment. And in my opinion, that's a good economic decision in their situation. But I think that is the unintended consequence of a lot of legislators that I think actually had the right intent at trying to impose all sorts of homeowner rights, like in California, the Homeowner Bill of Rights that exists. But it really wasn't thought out entirely as to these unexpected situations where now it takes years to be able to, in many jurisdictions, to foreclose and evict a borrower, where as a result, it makes lending much more expensive because they now have to take into account that you've got this long period of no income on that particular loan. And the other unintended consequence is that borrowers are making a strategic decision to default. And I believe that a lot of those strategic defaulters are actually great borrowers.
Interesting. That is really interesting. And you're right that, unfortunately, there are those who want to take advantage of the system that will take advantage of these laws more so than others. Let's talk about macroeconomics a little bit, and I want to take some broader views of the market, starting with historical. Going back to 2008, when we spoke last week, you made a comment to me, which I actually thought was very interesting, and it may be a little unsettling to those who are here, but I'd love to hear your take on it. And that was that the TARP program was one of the biggest mistakes that our legislators made in this country. For those that aren't aware of TARP or what it was, in short, it was the bank bailout. It was the millions of dollars that it was called, stands for Troubled Asset Relief Program. And it was the 700 billion, was 700 billion, was it?
Billion, yes.
Yeah, $700 billion bailout of the banks, where we basically propped up these banks that Congress and Treasury thought were too big to fail. And you have said to me that you thought that was a huge mistake on the part of our legislator. Tell us why you think that.
Yeah, it's and I appreciate your comment that some people might be unsettled to hear it, but you can even look through history and other types of situations like that. I believe it denied us the opportunity to be a phoenix and to come out of it better. And I believe that those banks should have failed. That any business that anybody that invests in a business and tries to make that business go, if it fails, you need to let it fail. You shouldn't, in my opinion, bail them out, because now for those entrepreneurs like I that try to figure out what is a good investment or not, it makes it difficult to predict what is going to be the outcome or not the outcome, because something like TARP, which was absolutely unheard of, and I don't think anybody ever would predict it, that the government would invest $700 billion to bail out the banks and entities like GM. I believe we should have let them fail. We should have let Bank of America fail. We should have let Wells Fargo, Citi, GM, all of those entities fail, which wouldn't have caused the recession, would have caused probably another depression. It probably would have, the trough would have been probably way deeper than what we had, but I believe it would have been significantly narrower. And so now, where we're starting to come out of that trough, it's 10, 12 years later, where I think the trough would have been much faster. And I believe, and I apologize for getting involved in politics, I believe if you look at the extent of partisanship and the infighting between the right and the left, I believe that TARP and that type of an approach just increased the divide. I believe that in a crisis like a depression, which we would have had if all those things failed, two sides come together and they try to find a resolution. And we can look in history where that's happened time and time again. The most recent crisis, I would say, being 9/11. During 9/11, everybody unified to be able to figure out, what can happen. And I believe that the crisis denied us that opportunity to be able to correct a lot of things that needed to be corrected. Right? The financial markets,
right.
Actually, if you think back to it, we shouldn't have been making 100% stated income loans. That was something that was, somebody should have stepped back and said, okay, well, wait a second. The government needs to be a little bit paternalistic in this situation because of what it could happen. But now, post-TARP, 10 years later, and you see the partisanship that takes place, I believe it has really hurt us, not only economically, but just as a nation, to be able to come together, because we were denied that experience to be able to figure out how to come out of what would have been, I believe, a depression.
It's a very interesting perspective, and it makes a ton of sense, actually. The rich have gotten richer. There's been a greater divide of the economics of this country. And as a result, that's bleeding over into our politics and all the polarization. Without taking a stance in either direction, I think you make a very, very good point in that regard. So outside of the world of real estate and mortgages, I agree with you. I don't believe that we're going to see another mortgage meltdown like we did before, primarily because the mortgages are originated very differently in the last decade. And while we can very well see a market recycle, some pullback in valuations of real estate, so outside of real estate and mortgages, are you concerned with any aspects of the financial world or the global economy, or where's the next hiccup coming from, if you had to predict?
Going outside the mortgage market, I mean, one area within the mortgage market that I think that we might have a little bit of a hiccup is actually in the FHA business. I believe that a lot of the FHA loans, although they comply with FHA guidelines, are loans that I never would have made, especially the higher LTV loans. And back in the B and C days, so the 80s, when we underwrote loans where we risk rated them manually on an A, B, C, D scale, we would put the bat signal up in the sky if default rates hit 2%. FHA loans have been hovering at, they just recently started dropping from north of 5%, but it's still well north of 4%. And I think that that's potentially a challenge and something that could lead to a hiccup in the markets.
Interesting, very interesting. Well, I really appreciate everything. I have one last question for you.
Yes.
You've obviously been very successful in your career. You're a smart individual. I really appreciate you spending the time with us here today. If I get everything that you're saying, and I'm a newbie to real estate and mortgage investing, or I just want to be the next Jon Daurio, what advice do you have for how to go about starting a career either as a real estate and mortgage investor or as just an entrepreneur?
Find something that has a malalignment. And what I mean by that was back in the late 90s, I actually had an origination company, a retail origination company, Loan Funding Corporation of America. And I was receiving a lot of my business from basically Long Beach Savings and Loan, Long Beach Bank, Long Beach Mortgage alumni that had gone off, formed their own entities. And then when they had a problem that loan, non-performing or compliance, they would just basically hand me the file and pay me $10,000 or whatever it was. And say, okay, give this borrower a refinance and use whatever portion of that $10,000 to compensate you for the fact that you might have to sell that loan as a discount. Because a fresh origination loan, typically, even if it was a lower interest rate, traded at a smaller discount than the loan that was non-performing. So back in the days, if you could believe it, a non-performing loan in those days would trade at 95 or something like that, where I know,
Wow.
crazy, where today, where back then a newly originated loan to somebody that was non-performing, and I gave them a lower interest rate, I might trade it at 98 or something like that. So I was able to take advantage of that delta. In 1999, the Graham-Leach-Bliley Act was passed, which was basically the institutionalization of privacy laws, where then I couldn't have a file just handed to me without the borrower's previous express consent to sharing that type of information. So I formed a company called Kondaur Capital, and it was a servicer. And I said, okay, I could still do exactly the same thing. I could get all these files as basically the servicer, but the boarding fee would be $10,000. So the reason why I bring that up is I saw that there was something that happened, the passage of the privacy laws, and I said, this is something that I could take advantage of. Same thing with Kondaur. I saw that with the crisis coming, and seeing that, okay, there's going to be a lot of non-performing loans and the inefficiencies and servicers at that time, I said, okay, now's the time to form something to be able to take a full competitive advantage of the fact that everybody else is servicing these loans incorrectly. Everybody else is selling these loans incorrectly, that they're doing the due diligence at the incorrect time. They should do it up front or behind. And today, I believe there's an opportunity for non-qualified mortgages to people with low credit scores, because I think they're better borrowers when you look at them as a manual underwriting. So my advice to your viewers is find something where you see some sort of malalignment, and that's where there's the opportunity.
That's really great advice. It's like being a problem solver. If you can solve a problem, you can make a lot of money and be very useful in whatever field you go into.
Yeah, and that's where I'm so grateful that we are a capitalist country, so that I can take advantage of those types of things.
That's really great. Well, we've been with Jon Daurio. Thank you so much for your time today, with spending time with our Win-Win Investor Network. We'll hope to come back and interview you again after you've launched your new origination strategy. And you can advise us on the success of that, which I'm sure will be, as well as you've given some great advice here today. Thanks again, Jon.
Thank you so much, Bill. Take care. Bye-bye.